Manu Vandenbulck is Senior Investment Manager at ING Investment Management. Hi, Manu.
Good morning.
Is a divergence beginning between emerging and developing markets, or is it just a one-month anomaly? I mean, there's barely any change, to be fair, is there, between developing and emerging?
Well, yes, indeed. On such a short horizon, it's really difficult to point out if there is a change in underlying trends. However, what we do see is there is increasing momentum in, let's say, skepticism about emerging markets, sustainable growth rates, and risk going forwards. But actually, that creates interesting entry opportunities for us with a longer-term view.
Yeah, I mean, you say that the growth rates should be maintained in Russia, in India, and in China, and emerging markets are trading at a discount to developing markets. Is that still the case?
Well, yes, it is still the case, although it's not the discount that we used to see 10 to 20 years ago.
Yeah.
But we still find relative support from valuations compared to developed markets, but also underlying fundamentals are supportive. Especially if you have a dividend bias, we find attractively covered dividend in emerging markets and sound underlying fundamentals, given that we don't face issues such as deleveraging that we've seen.
But the payout ratio is lower compared with companies in developed markets, isn't it? That's worth noting.
Yeah, exactly. It's about 35% the payout ratio globally, while for emerging markets it's on average about 20%. So again, this gives us comfort about dividend sustainability and the potential to further increase dividend payments in these markets.
Which industries, which companies, which geographical regions, we'll try and pinpoint it, are paying the best dividends, have the most reliable dividend stream right now?
Well, we actually have a diversified approach and not so much a sector bias in our emerging market dividend fund. And we basically find attractive dividend yields throughout all sectors. Now, I must say that given recent strong performance in the consumer staples area in general, we find limited valuation support in some of the food producers in emerging markets, given that so many investors have been going into that area to find secure dividend yields. Valuations are actually no longer supportive. But you can find very attractive dividend yields in sectors such as utilities, which are basically also exposed to increased increased consumption in these markets. From an area point of view, I'd say that if you look on a year-to-date basis, markets such as Brazil and Russia, they have had a good run, and China now is becoming more interesting.
The RTS is up, the Russian benchmark, it's up by 23%. Would you say it's sustainable now that Putin has won election again to be president? Are those sorts of gains sustainable, or are there doubts? Are there geopolitical doubts about Russia going forward?
Yeah, political risk is definitely an area that you have to keep an eye on globally in emerging markets. Now with Russia, indeed, let's say from a political perspective, short-term risks have waned, but we'll see what happens further down the year. Now that now that the outcome is near, now that the outcome is there, and yeah, we'll see how this rolls out. It's definitely an area to watch for the next 12 months.
This is where I get you to put your head on the block, Manu. I've been looking through the Bloomberg terminal, looking at the best performing primary stock indices in the world this year. And interestingly, Venezuela's up by almost 70%. And looking down, Egypt's up by 38%. Budapest is up by 23%. Bucharest up by 24%. Which emerging market right now do you think is looking most attractive for 2012?
Well, again, I think we are attracted by valuations in China, where underlying fundamentals, if you have this longer-term view, let's say 3 to 5 years, there are increasingly opportunities that we find in that area.
Okay, Manu, thank you for joining us today. Manu Vandenbulck there, Senior Investment Manager at ING Investment Management.